Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you on Thursday, March 6th from kind of nice and cool but beautiful New York, New York. It rained last night as I went to the Caps Rangers game. Good opportunity to get to Madison Square Garden, take in some hockey. Saw Ovi get closer to Gretzky's all-time record if you're a hockey fan, but it was pouring rain. And once people found out I was from Seattle, I started to get all the blame. But that's fair. Um, Hope you all are doing well. You probably, and I'll tell you another thing as we get started. I feel like the kickoff time of Chart This is probably directly proportional to the amount of dramatic moves we see in the markets. The crazier the markets are, the more I'm going through a bunch of different things, a bunch of different charts, trying to identify some of the key ones that I want to highlight for you. On easier days, I'm able to kick off right at 5 p.m. Eastern. Days like this, it takes me a couple extra minutes trying to put together the narratives and figure out where I want to focus some of our time and attention here. As a reminder, we are live streaming on Facebook, LinkedIn, YouTube, and X, and I appreciate you so much tuning in from anywhere, particularly hanging in this week as we do it remotely from New York. We are heading to Baltimore tomorrow. We will be doing an all mailbag episode, though, from Baltimore, and we'll be flying back home to Seattle. Very excited to get back with the family and the Pacific Northwest, and we should be to a normal publishing schedule on Monday. With that in mind, quite a bit of distribution today. Of course, I would say the bearish themes we've been talking about continuing to play out. I am starting to see the I don't want to say perma bulls because I don't like to label people. I certainly don't like to be labeled, but I'm definitely seeing people that I would expect to come out and start screaming buy are doing so. However, I have found trust the charts. When the charts tell me they're going down, I don't want to own. I don't want to own those things. And I'm a big fan of the charts telling you when they deserve to be in your portfolio, but then also listening very clearly when they tell you they do not deserve to be in your portfolio. I've seen a lot of things that feel like they don't deserve to be in my portfolio right about now. With that in mind, let's look at the markets and how they played out today. If you like the color red, you're going to enjoy today's episode with very much quite a bit of that. Starting with the main page here, looking at the market dashboard, the market benchmarks, the S&P 500 closing just around 5738. That's down 1.8%. The NASDAQ composite really leading the way lower. We continue to see growth underperforming value in 2025. And today, continuing that theme, down another 2.6%. Mid caps, small caps, all down as well. S&P 600 small cap index, for the record, down the least, down about 1.25%. The NASDAQ 100, of course, mega cap growth, down 2.8%. The NASDAQ 100 is getting very close to that 20,000 level, which might be an important one to watch. The VIX moving up almost 3 full points today. Yesterday, we were talking about the VIX down around 22. Today, we're talking about the VIX around 25. So 20 appears to be receding in the rearview mirror as the market uncertainty continues. Obviously, I'm already seeing in the chat some of you talking about tariffs. I mean, this is one of those times when, day-to-day news flow is certainly rocking things. And again, I am a big fan of not getting too political, but in the course of analyzing the markets, you have to address geopolitical issues and certainly the political situation here in the U.S. and how it's impacting things. I saw a quote earlier today talking about how, President Trump isn't really paying attention to the markets. I cannot believe that that's true, only because this is someone who is laser focused on a lot of things like that. If it benefits the story that you're trying to portray, the narrative you're trying to portray, I would tell you what it means with an incredibly strong stock market going into this first year of a new administration. Trump has a lot of leeway and a long runway to do whatever he would want that could be perceived as very negative for stocks. Already taking some aggressive moves that are, arguably not great for the markets, and the markets are starting to go down, but they're still not down a ton. He's got plenty of time to do some pretty disruptive things, and then plenty of time to make it all better by the time when we're really able to maybe pass judgment on the approach and all of that. Investors and certainly voters tend to have a very short-term memory. So if there's a lot of pain followed by a little bit of good, we tend to remember the little bit of good. There's a recency bias that I think is in effect for investors and certainly for voters. So that is my 30-second take on what is going on here. I would say that aggressive moves geopolitically, economically, there's plenty of time to to make those moves, to do things that are more aggressive that could be perceived as negative. Watch the markets go down to a degree, but then have plenty of room to recover. That would be my guess on what's going on here. Having said that, continuing on here, bonds moving lower today. So stocks and bonds both moving to the downside. You're going to find that theme. There's very few things actually moving higher today, although we will find some stocks doing so, particularly after the close. You got Broadcom, got Gap, gapping higher, pun intended, with both of those names in the after-hour session. So we'll see. But bond prices moving lower. The TLT was down about 1/3% today. Interest rates moving higher. 10-year yield currently just below 4.3%. 5-year sitting above 4.06. And the long bond yield right around 4.6%. Dollar index, no real change from yesterday. To be totally honest. Now it did earlier in the day was quite lower, but drifting higher through the course of the equity trading session. Looking at commodities, all in the red here, and you can see the GLD down about 0.5%, silver down 1/3%. Most of the top 8 commodity ETFs tracked on stock charts in the red. One of you mentioned, I see in the chat, my interview on Market Misbehavior podcast with Christina Hooper comes to mind as we're talking about commodities. We talk particularly about the strength in gold, about non-U.S. stocks, and really focusing on areas of the market demonstrating strength or the potential for further strength, given the disruption in U.S. equities. Gold and precious metals were one of those areas that we talked about. GLD down about 0.5% today. I think still a pretty strong technical profile by my calculation. Cryptocurrencies as volatile as ever. You can see Bitcoin in the last 24 hours up above 92,000, down below 88,000, and currently right in the midpoint, just above 90,000. Big round numbers tend to be pretty important. I'm watching that 90,000 level to see if Bitcoin can establish a foothold above that level. Of course, all-time highs 108,000, quite a distance above current levels. So overall, I would say Bitcoin and other cryptocurrencies certainly on their heels a bit. We'll see if there's some stability, and Bitcoin above 90,000, I think, would be the first step to that sort of technical recovery. Looking at the 11 S&P sectors, we can see it's not great, and the growthier you were, probably the worst day that you had today as a generalization. Worth noting, 2 of the 11 S&P sectors did manage to finish in the green. The energy sector up 1/3%, 0.3% higher for the XLE. Consumer staples, number 2, essentially just slightly above the zero level, 0.2%. Healthcare third from the top, and it was down about 1/4%. On the downside, the big losers today, technology down another 2.8%. I did grab some random tech charts, including semiconductors, and I forget what else to go through here, but a lot of continued distribution there. And this is some of the weaker areas of the market that we're seeing year to date. Real estate, which has actually been relatively strong year to date, one of the 4 defensive sectors doing quite well today, giving back some of those recent gains, down 2.7%. Consumer discretionary down another 2.5%, followed by utilities fourth from the bottom. As we've highlighted, our market trend model looks more and more likely that it will finish the week bearish. The medium-term market model has been bullish for quite some time, going back to the fourth quarter of 2023. When I think about signs that tell me that this could be a much longer and more painful decline, things like a spike in volatility come to mind. Things like the S&P breaking lines in the sand, both of which have happened in the last week. And then the third one would be my medium-term market trend model turning bearish. That remained bullish through all of 2024. Great reinforcement of the long-term uptrend, and to treat pullbacks as actionable pullbacks within the uptrend phase. But the medium-term trend model very close to turning negative now for the first time since I think October, early November of 2023, coming out of that major low in late 23. Breadth continues to suggest the distribution here. You can see about 2-to-1. 2 out of every 3 S&P names finishing in the red, 67% decliners to 33% advancers. Almost the same for the NASDAQ composite, and for the New York Stock Exchange, about 70% decliners. So, you're very much seeing a distribution phase. We're seeing, broad declines. We're seeing more stocks break below key moving averages. those are the kind of things that are hallmarks of a bear market phase. And the good news is the technical toolkit provides plenty of opportunities to define that downtrend if it persists, and to identify a potential low. And assuming we break down further going into next week, that's what we'll pivot a lot of our thinking to be. Is all right, now that we're in a downtrend, where do you see signs of accumulation? Where do you see potential support levels? And so forth. But for now, I'm focused more on the distribution, the fact that key moving averages don't appear to be holding, although some of them are, and let's continue to monitor those and see if and when they hold up. You'll notice all of the Magnificent Seven and friends, not so magnificent today. Apple, the best, still down about 0.2%. Alphabet as well, down just under 0.5%. Netflix getting absolutely clobbered, though, down 8.5% today. Nvidia down 5.7%. Tesla down another 5.6%. I mean, Tesla going down is nothing new, so I don't feel like I'm reporting any new incremental information here. But Netflix has been one of the better charts. I mean, when you look at 2025, which of the Magnificent Seven names could you still label as magnificent? I would probably say Meta and Netflix would be the two that come to mind. Maybe one or two others, but not many. Most of them have been struggling quite a bit. Netflix has been one of the better ones. And what's happened in the last couple of weeks is we stalled out trying to get above 1,000. We've now broken below 1,000, which has been short-term resistance here over the last week. And then today, dropping significantly down, 8+% to trade just below $900 a share earlier today. So again, one of the big check marks on my bull market top checklist, things that help me anticipate and define and then confirm a major market top. One of those sort of structural changes would be the previous leaders really start to struggle, right? The heroes in the previous bull market often become the villains in the next bear market. So whatever was leading higher often struggles because that theme has become way overplayed. That's what allows the markets to go higher. And all of a sudden, those things start to get derailed very, very quickly as investors quickly take profits and want to unwind some of their previous winning positions. Netflix trading lower, like I'm seeing here, just seems like one of those classic kind of post-top events where some of those previous leaders just accelerate to the downside, have a bit of a waterfall decline. So the evidence is not great if you're bullish and looking for that buy on the dips kind of signal. And again, I'm hearing some talking heads declare, this is a great time to buy. I would not describe this as one of those just yet. As a trend following technical analyst, I'm seeing a lot of distribution. Now, the kicker is the S&P is still holding its 200-day. If that holds, I think that's right. I think that's the right way to think of it. But given the distribution, given all the other signals we've seen up until today, that's why this continued weakness in stocks makes a ton of sense, I would say, from a technical perspective. All right, let's go to the market carpet, a heat map style visualization. As a reminder, what I love about this is to be able to look macro to micro, look at the big picture and look at the micro picture as well. On a day like today, where it feels like everything was getting crushed, what was not getting crushed? That's the main question I think we should be asking. So in a world of bright red, what actually shows any tinges of green? Those are potential opportunities, because what that means is those particular stocks were not sold off along with all the other names. They were actually finding a bit of a bid here in a period of market distribution. So let's start with the bright red. We'll start in the upper left corner. Technology, of course, leading the way lower. And I'm immediately struck by Nvidia, Broadcom, both down about 6% today. Oracle down over 6%. Palantir down another 11%. And again, Palantir may be a great long-term story, but in the short term, the weakness is so severe. I think you have to patiently wait for the chart to tell you it's time to get back in. And I'm not seeing that. I'm seeing further distribution at the moment. A lot of semiconductor names I'm seeing in the bright red. Random things not in the bright red. And again, look for things that are kind of neutral, like Intel, Apple, not down much. Akamai Technologies. These are names. Hewlett Packard. These are names that actually managed to hold up when most things were weak. But chart like Hewlett Packard, not a great chart. This is bouncing off of a fairly weak level. Also noting quite a bit of distribution in the financial sector. That's been one of the key stories this week. Financial is one of the more compelling places to be, I think, year to date. And while you see some random names like Market Access starting to bounce off of a beaten down level, some of those names that had been doing quite well like the payment processors, Visa, MasterCard, like the banks, JP Morgan, Bank of America, all continue to rotate lower through the course of this week. Within consumer discretionary, within communication services, some of those biggest names having some of the biggest losses. Communication services, Alphabet, a notable outlier that it wasn't down much. It was essentially flat for the day. Also noticing in energy, ExxonMobil, Chevron, both having up days. Valero, Phillips 66. These are all stocks that were up today, while the markets were down. In the materials sector, you can see Albemarle, Mosaic, and again, I mean, the problem is those charts are pretty rough charts, right? Mosaic is just coming off of a 52-week low yesterday. Albemarle coming off of a 52-week low yesterday. So while I'm thrilled that they're up 3+%, still not the type of chart that I probably want to own yet, because while you're bouncing higher today, the trend overall is still not enough to to really, I think, deserve your attention. Also noticing some of the sectors with sort of a mixed view. You can see within industrials, some stocks up a bit, some stocks down a bit. You can see the same within healthcare, arguably within materials, as I mentioned. So again, in a day like this, when everything's down, looking for things that are actually starting to rally can be interesting. Again, but the challenge I have with a lot of those names in the green today is they're pretty rough charts, right? Over the long term and medium term, they're just bouncing off a very weak level. So I still would not, it's either things that have been doing well that are now not doing well, or things that have been doing so poorly that are bouncing a bit. But none of those are the types of charts I would generally want to get into, which are charts that are strong and are demonstrating additional strength. And that is something you're seeing very little of right about now. Also, I mean, defensive sectors overall, not great today, but you can see something like consumer staples continuing to look more compelling than consumer discretionary. And I think the big difference is some of the biggest names in staples are actually holding up pretty well. So you look at Coke, Philip Morris, Pepsi, Procter & Gamble, all flat to slightly higher, while the major averages were down, 1-2+%. All right, we'll continue on looking at the chart review portion, looking at some individual stocks. I grabbed quite a few charts. I had to just stop grabbing charts because I needed to kick things off here, but that's why we kicked off a few minutes late. I was finding so many charts that I thought would be interesting to review with you here today. Before we get there, I do want to remind you I'll be speaking at the Virtual Expo for the Money Show next week. I think that's on Tuesday and Wednesday. I will be speaking Wednesday, March 12th. 2:50 p.m. Eastern. That's 11:50 a.m. Pacific time. I'll be doing a presentation called The 4 Deadly Sins for Investors. We'll talk about why you buy too early, why you buy too late, why you sell too early, and why you sell too late, the behavioral reasons why that happens, and some quick technical tools you can use to minimize that happening going forward. It should be a fun 30-minute sprint through a bunch of different ideas. I guarantee you'll leave that session with a couple ideas of how you can improve your own entry and exit points. I hope you can join me there. You can sign up for that free event at marketmisbehavior.com/money show. It will take you to this page on the Money Show website where you can sign up for that event. As a reminder, I can see the rapid fire comments happening on the different platforms where we're streaming. We're on Facebook, LinkedIn, YouTube, and X. Thanks so much to those of you that are tuning in live. If you are welcome to ask questions as we go, and I'll grab a couple hopefully before we end the live stream. If you're watching on the replay, no worries. Put a question in the comment section of our YouTube channel. Hope to feature your question on our all mailbag episode on tomorrow, Friday, March 7th. All right, continuing higher, the 200-day moving average remains in play, right? Tuesday, we traded down to the 200-day. Yesterday, we closed back above there. And then today, we actually traded on an intraday basis below the 200-day, which has not happened so far this week. We did manage to close just back above the 200-day. That's good. And it would be worse if we had not done so. However, I think this test of the 200-day is pretty much vital. After you break the 200-day, I'm kind of out of support levels, to be totally honest with you. I mean, I can identify some secondary support levels, but I think the 200-day is a big one. And I'm actually working on a course, a virtual course from my Market Misbehavior Premium members on different technical indicators. And when I'm talking about the 200-day moving average, I mean, there's so many things about the 200-day that are important. I mean, number one, people like Paul Tudor Jones famously saying nothing good happens below the 200-day moving average. Having spent a lot of time personally with institutional investors, buy side, sell side, all across the world, I would tell you people that are even not super chart oriented traders or investors just happen to know where the 200-day moving average is. It's part of the general vernacular of talking about stocks. If you're involved in the market, it feels like that you often bring up a chart and look at the 200-day. So what happens a lot of times is we will often bounce off of the 200-day. I think we're seeing some of that this week. But what that also means is if and when we finally break below the 200-day, that's when things can get really bad really quickly, because once people recognize that long-term barometer is not going to hold, that's when you start to get nervous. There are plenty of people hoping and assuming that the 200-day will hold here, thinking it's a great time to buy. They may have been putting in some orders here through the course of this week. I love the optimism, but the problem is when all of those people recognize and have to admit that the 200-day is actually not going to hold, if that's what happens, then they start to unwind those positions. That creates additional selling pressure, which fuels additional selling. That's where a waterfall decline can really start to accelerate. So I can't stress enough, I think we're at a crucial point here. I think we break below the 200-day. I think you have to really think about further downside targets. I'm eyeing the 5,400 to 5,500 level as a general downside target. A couple reasons why, using Fibonacci retracements, using some previous support levels. I did a video on the Stock Charts TV YouTube channel on Tuesday of this week, addressing some of those downside targets. So if you want to learn more about it, check me out there. Some other sort of big picture charts to review with you guys today. The newer Dow theory is looking at the equal-weighted S&P 500 and the equal-weighted NASDAQ 100. This is, basically a modernization of Charles Dow's use of the Dow Industrials and the Dow Railroads. He was looking at two main pillars of the economy and whether they were in agreement or not. I think a good way to modernize Dow's original work is to look at an equal-weighted S&P and an equal-weighted NASDAQ. The S&P representing more old economy names, and the NASDAQ 100 representing more new economy names. When one of these breaks out and the other one doesn't, that's called a bearish non-confirmation. We actually got that in mid-February. One of the many things in mid-February where you probably started to pick up on my not so subtle reflection on how things were starting to be a lot less bullish. That was one of the reasons, was the bearish non-confirmation. A confirmed bearish signal, a Dow theory sell signal, would occur if both of these undercut their recent lows, and that's getting very, very close. The equal-weighted NASDAQ 100 actually almost made a new low for the year today. Didn't quite do it, but very, very close to doing so. Equal-weighted S&P is a couple points above that. I'm using two ETFs to track that, but you can use the equal-weighted indexes, and it gives you pretty much the similar story. So I think we're very, very close to a newer Dow theory breakdown in a way that we've not seen in quite some time. And I think that would be yet another real bearish signal. That's one of the check marks on my bull market top checklist, is a Dow theory sell signal. I think we're very close to getting it. We talked about how the breadth today was sort of weaker than you'd want. We're now to about 42% of S&P names holding their 50-day moving average, which means most of the S&P 500 are below. And actually, technically, as of today, most of the S&P are below their 200-day moving average as well. We're just slightly below that 50% line as of today's close, and that's a problem. This indicator, that blue panel, which is basically the percent of stocks above their 200-day moving average, has held 50% since November of 2023. We talked about that as being the last sort of major corrective period, a multi-month decline, which we've not seen since sort of July through October of 2023. This indicator getting below 50% was one of the many things that confirmed we're in a bearish phase there, and told us to think much more defensively. We're very, very close to sort of confirming a similar pattern here. So we're very close to the S&P breaking its own 200-day moving average, most S&P names being in a similar bucket, and I would say that is a sort of a problem. The NASDAQ 100's bullish percent index, I just want to bring this up because it's kind of an interesting way to think of it. The bullish percent index is a breadth indicator based on point and figure charts. And the NASDAQ 100's bullish percent index, at least in recent years, I've found looking for when it gets below 30% often is a sign that a major low is very, very close. We've seen that in the last three major lows for the S&P. I would say the August 24 low you can see there, the April 24 low we can see here, and even going back to the October 23 low. Similar with each of those major lows is the bullish percent index on the NASDAQ 100 went below 30%, which means 70% of the NASDAQ 100 members were in a bearish point and figure signal. We're not there yet. And I think that's, one way to think about this indicator is it tells you we've got plenty of room to go lower and still not be to a major buyable point, according to this indicator. The real buy indicators, the real signs of a washed out market for this indicator occur when we get below 30%. We're currently just below 40%. So that suggests that there could be more room to go with some of those previous previous leadership names to get down to the point that is similar in the configuration to other major lows that we've observed over the last year. We'll keep an eye on that indicator for sure, but for now, it's telling me we're not at a major low yet, according to that methodology. The VIX continues to push higher. We talked a little bit on yesterday's show or the day before about volatility regimes. And I think we are definitely in a new volatility regime, right? The volatility from mid 23 to mid 24, as measured by the VIX, was a very low volatility environment. The VIX often got down to the low teens. On rallies, it rarely got much above 20. Now, all of a sudden, we saw that big spike above 20 in July into August of last year. And from there, the VIX has remained quite elevated. We did get briefly down to the low teens in early December, but we've spent a lot of time in a much more elevated level. We're actually getting back to the ranges that we were in 2022, a period of much higher volatility. So if we get into a high volatility environment, I mean, it's challenging in that there's a lot more noise, there's a lot more movement. The good news is for technical analysis that volatility usually means opportunity, particularly if you can swing trade, if you can identify, extreme moves and bet on mean reversion. More volatility is a good thing, right? I mean, it's sort of a more it's a greater opportunity to bet on price swing. So elevated volatility could be a good thing. The problem is, as a macro indicator, though, major bear market phases are usually marked by elevated volatility because we tend to be more anxious, or we as investors tend to be more anxious. We tend to be panicking, and as a result, the VIX tends to accelerate. We are now at the highest level that we've experienced here in 2025, getting near to some of those higher spikes that we observed in December of last year and also August of last year. Updated sentiment readings available today. The AAII survey, not a huge change, to be honest with you. Bulls are about the same. And what's so interesting about this indicator, it's so funny that, the bullish reading rarely gets much below 20%. And I feel like those are the perma bulls in the AAII survey. It's like, it doesn't matter what is going on in the markets, you're still going to be bullish. And so they're there and continuing to say every week, yep, I'm bullish on stocks for the next 6 months. God love them for remaining and holding steadfast to that bullish perspective. But I mean, even in 2022, arguably, I mean, one of the most bearish years we've experienced in recent history, certainly post-COVID, still 20% was sort of the floor that we never really got below there. So 1 in 5 investors just hammered down, always going to be bullish. And that's that appears to be pretty normal. So no change there. Bears actually declining slightly, but still around 57% bearish. Still some of the most significantly negative readings we've seen in the AAII survey for quite some time. Name exposure index did finally start to come down a bit. Last week, we were almost 85% or so. This week, down about 10% to 75%. So money managers in this particular survey lightening up, sort of taking the foot off the accelerator, not quite stomping on the brakes, but getting their foot over in that particular area of the car. And we'll see if that continues to get more defensive here. But overall, I mean, not a huge unwinding of positions yet. I mean, previously when we've had more protracted declines, we have much lower readings of that indicator and not there yet. I wanted to highlight, when we're looking at relative strength, some of the charts in my Market Misbehavior Live chart list focus on relative performance. And I have 3 charts, one looking at growth sectors, one looking at value sectors or cyclical sectors, and one looking at defensive sectors. That's how I generally group the three groupings of the 11 S&P sectors. But I just want to highlight, out of those 11 S&P sectors, which ones are showing the strongest relative strength and are actually making new relative highs this week for the last 3 months. And from the top, it's communication services. Out of the 3 growth sectors, that's the only one continuing to show quite a bit of strength. Consumer discretionary, technology, very much not doing so. Healthcare and materials out of the value sectors. Energy and industrials not as strong, but you can see healthcare, the XLV, and materials, the XLB. both showing quite a bit of strength. And then consumer staples out of the defensive sectors, I would say this is the one still continue to outperform quite a bit. So those are your four sectors performing quite well on a relative basis. Now, while some of the charts in those sectors are not as strong on a price basis, right? They're not making new highs anymore. In this type of environment, what do? Well, you either go to cash, you go to some other thing like gold, or you invest in areas of the market that are outperforming, that are doing better than the benchmarks that are struggling quite a bit. If you're not in these four sectors, I would encourage you to be looking through charts in those sectors to find opportunities, because those four sector ETFs are making new relative highs for the year this week. So these are the ones still in a strong relative position, even if they're not doing well as much on a price basis. This is where I would want to be. Generally speaking, right? If you want to outperform the S&P, you have to own charts that are outperforming the S&P. These are four sectors actually getting it done this week. All right, we'll finish off talking about some individual names. I'll take a question or two, and then we'll wrap it for the day. Netflix getting dinged pretty good today, and we highlighted Netflix on the show yesterday. We talked about Netflix as one of those names in the previous Magnificent Seven that had been, still not that bad. And if you didn't know the world was ending outside of the of this chart of Netflix, not too bad. And we talked about holding an ascending 50-day moving average is pretty crucial to that particular thesis. Today, dropping significantly below the 50-day. So in a bull market environment, in a strong bull market environment, leading stocks hold an ascending 50-day moving average. I'm finding very few that are still doing so after the last couple of weeks, and Netflix just the latest to fail to hold the 50-day. So when stocks don't hold an ascending 50-day moving average, well, it doesn't necessarily mean the end of the world. It certainly means a change of character and more of a defensive rotation. I think the chart of Netflix now quite vulnerable. Now, what's next? Well, I mean, the 200-day moving average is kind of the next level, the most recent low. So we're still making higher highs and higher lows, which is good. 825 would be the swing low from January. But again, the break below the 50-day also takes us below that gap. That was the gap in mid-January on earnings. And so you expect a hold there, right? It was the high in December lined up with that gap. Now we're below it. So we'll see if we get downside follow through tomorrow. But overall, I would say today, a pretty dangerous move. Amazon down about 3.7%, down to the 200-day moving average, right? Amazon was one that broke its 50-day a couple weeks ago. One of the many things we highlighted as an moment, bearish divergence, breaking the 50-day, that's usually not good. It already has broken its swing low from January. That's also not good. Last thing left is the 200-day moving average. Paul Tudor Jones, again, famously said, nothing good happens below the 200-day. So charts like Amazon holding their 200-day, pretty important. If Amazon and other names like it are failing to hold their 200-day going into next week, I don't see how you can be particularly bullish given the technical deterioration. I think you have to assume risk off until proven otherwise. To add to the running list of things breaking down and not holding support, which again are bad for these individual charts, but I think also have negative implications for the broader market, semiconductor ETF. You look at the SMH over the last 6 months. We highlighted this chart about a month ago, I want to say, on the show, this particular chart with these two lines. We had the green line and the red line. And the argument was, if we break above the green line and follow through, that's very bullish, which is why in mid-January, it was sort of boy, this could be something really significant. As you can see, we very quickly gapped lower and did not hold that breakout level at 260. The SMH breaking below the red line around 235 would mean new multi-month low and failing to hold support. What's happened in the last week and a half is the latter has occurred, right? Instead of breaking out to new highs and holding, we're actually breaking below support and holding that breakdown. So overall, I would say semiconductors as a group in a clear distribution phase. We went from an equilibrium, which could have gone either way. It went the bearish way. And I think until proven otherwise, that means distribution. Does anything look good? I will share with you a couple charts that are not horrible. And while they're still in downtrends, at least they're starting to show signs of accumulation of some sort. Home builders have been especially weak, right? And I would say that while home builders looked quite strong going into the fourth quarter of last year, higher interest rates, mortgages not getting particularly cheaper, all started to hurt these home builder names. D.R. Horton made a new high around $200 a share in September. And from there, we've had a pretty consistent pattern of lower highs and lower lows. And that pattern, to be clear, persists through the last couple of weeks. However, we may be finding a bit of a short-term support level around 125. That held us support a number of times in the month of February. And this week, we're actually starting to bounce higher a little bit. We're still below the 50-day moving average, which actually held as resistance a number of times here, most recently in mid-January. We're holding a trend line resistance. If you take the October high and the November high, that lines up with some highs in January and today's high. But we're very close to breaking above that trend line resistance. So how bearish do I want to be on the chart of DR Horton if we're breaking above trend line resistance after finding support? We're breaking above the 50-day moving average. The RSI is pushing above 50. None of those things are happening yet, but we're really right at that decision point where it could. This is the type of chart I would personally say not quite ready for a long position in my opinion, but one that I would continue to monitor to see if that breakout sort of progression would occur. This is the kind of thing I'd put on a watch list to see if that follow through would occur. Home builders like DR Horton have been in downtrends. Maybe if these previous leadership names continue to deteriorate, maybe it's charts like this that start to improve in a way we've not seen in quite some time. Market Access MK TX is one of the top performers in the S&P today. It was actually up while most things were down, but I just want to highlight on the weekly chart. Another thing that I would say is when you have a stock that's been beaten down like this, I love to look at the weekly charts. Look for the weekly MACD or the weekly PPO, looking for a buy signal. On the weekly chart, that's one of those things that can help avoid getting in too early if something's just a short-term bounce. But when you finally get that weekly MACD or weekly PPO buy signal, it can often initiate or be the sign of an initiating new uptrend. We've had that a number of times here with Market Access over the last 2 to 3 years. Not quite there yet. You can see the buy signal has not quite occurred. But again, another one that I would put on a watch list to see what happens. Two charts I just want to check in after the close. Broadcom, as I'm preparing for the show, we're talking about this technical concept of polarity, resistance from the second half of 2024 turning into support. This week, we're also testing the 200-day moving average, which did hold quite beautifully in September of last year. Let's take a look at what's happening. When I was getting ready for the show, it looked like it was bouncing actually quite nicely. Yeah, it's up about 16%, currently around 208, which means it's right around the 50-day moving average as we do. Is that true? 208, yeah, 208. All right, so we're right about here. So that means we, again, if we open tomorrow around 208, that's a nice bounce off of the 200-day moving average. Again, that's the bull case for charts like this as the 200-day holds. And usually in a normal environment, I would assume that's going to happen and even be happy betting on that. It's just all the other things that have told me that we're more in a period of deterioration has me skeptical that that's going to do it. If you get a nice bounce in Broadcom, is that enough to have stocks finish in a period, in a day of strength as opposed to weakness? I mean, maybe. We also got, I think, the jobs number tomorrow before the open could be the 1-2 punch. We'll see. Gap's another one, by the way. GAP, the clothing retailer. We can see on the daily chart this $19, $19.50 or so is what I'm highlighting here. That was the low from April of last year. You can see it lines up with August, September lows, and also where we're at right about this week. We're oversold as we're testing this major support level. Generally speaking, that means I would say anticipate a bit of a bounce off of that support. For now, after hours, up about 15%. This was an earnings name today, by the way. And this is gapping up to, what, 22.50. So that would basically take us right back to the 200-day moving average, which would be good. Gap has not been a great chart. I mean, right, if you look at the price action over the last year, it's essentially flat here. But, again, stocks not breaking down are probably going to outperform as most things are breaking down. So charts like this able to hold support could be a rarity here in March of 2025. All right, thanks for hanging with me as we go through all of these different charts. Let's answer some questions. Mohammed, thank you so much for watching on YouTube, and thanks for the compliment. Great session, I appreciate it. Could you please talk about what you see in Europe, especially the German market, the DAX? Europe has been so strong. 100%. Actually, I was doing the monthly chart review for my Market Misbehavior Premium members earlier this week. I think that was on Tuesday. It's a bit of a blur as I've been on the road here, but earlier this week we went through that, and part of what I do is apply my market trend model, which is looking at 3 different time frames on the weekly chart, to a bunch of different things. We talked about non-US markets and others, and I'll show you like EWG. And again, you mentioned the DAX. I totally get it, and you're welcome to run it on the DAX as well. I was just running it on the EWG, which is the U.S. listed iShares ETF for Germany. But either I think they're pretty similar at this particular moment. I mean, Germany looks quite strong, and what is different here? A couple different things, and maybe too many things to summarize. But one would obviously be a lot of disruption here in the U.S., a lot of tariff news and everything, fears of inflation. All of that is causing unusual deterioration in a very short period of time for U.S. stocks. That's number one. The second thing I would say is through 2024. The U.S. outperformed non-U.S. markets pretty consistently, and I would say a big part of that would be the sector weightings and just what the U.S. market is geared toward, what the biggest weights are versus something like Germany. One of the big differences between the U.S. and other major European indexes, Canada, Japan, is the fact that the U.S. benchmark is dominated by large cap growth stocks, right? So the big tech and communication names, Meta, Amazon, Alphabet, NVIDIA, Microsoft, Apple. These are huge weights in the U.S. benchmark. So when those themes are working, which is what was the story of most of 2024, it's really hard for something like Germany to outperform the U.S., even if the chart is going up, because the U.S. stocks that are at the biggest weights are doing so well. So our growth-oriented benchmarks are probably going to outperform, and that's what happened. In 2025, the growth trade has absolutely evaporated, and we've seen rotations into value sectors like financials and into defensive sectors like consumer staples. Non-US benchmarks are way more geared usually to those sectors. So a lot of the European benchmarks have a much bigger weight in things like consumer staples and other value-oriented. They're more value-oriented indexes. So when growth is underperforming value to the degree that we're seeing, non-US stocks are probably going to do a lot better. I would also say the weaker dollar was incredibly strong in Q4, incredibly weak in Q1 of 2025. So those three things really causing non-US markets to do quite strong. So my market trend model, you can actually apply it on charts like the DAX. We're bullish on all time frames, long-term, medium-term, short-term, all bullish. The US market has been bearish since the beginning of 2025 on the short term. And as of this week, it looks most likely like it's going to turn bearish here. So non-US markets, particularly developed Europe, Germany, UK, Switzerland, looking quite strong. Even Poland. I mean, these are other charts looking quite strong, breaking to new highs, while the U.S. markets are starting to break down and test support or flat out break those. So 100%. And I don't blame investors that have been underweight non-U.S. stocks because of the strength we've seen in the U.S. up until this year. But if you're still completely underweight and not invested outside the U.S., I think you're missing a big rotation that has been in the works here for the last 6 to 12 weeks. Thanks for asking about that, by the way. Let's see one other question before we finish. Boy, a lot of discussion here happening. Let's see. Calvin, thanks for watching. People shorting here are the same folks that would chase long in an overbought condition. Ooh, that's a tough question. Is that true? Maybe. That's an interesting one. I'll have to think about that one. That's not a quick answer one. I mean, maybe, right? I mean, I think I guess if you're shorting here, you see the initial signs and you think there's going to be much further. And I think that's what you're talking about. The same ones, you're chasing the market. But here's the thing, right? I don't know if I would describe being short here as chasing the market. I mean, based on what I'm seeing, if this is the beginning of a much further decline, this could theoretically be early days of a correction, right? I mean, that's sort of like being short in the first quarter of 2022. You could make the same argument that they were chasing the downside, but talk about being proven right for the next 3 to 6 months. So that what you're saying is only true if this is just another buyable dip. And I don't know if I'm seeing just a buyable dip based on the configuration that we're seeing here. Again, as a technical analyst, I think you analyze price, but then you also look at the weight of the evidence across the board. And a lot of the things we've been talking about, all the things on my bear market, bull market top checklist have been checked off one by one. And we're not quite to the confirmation where everything's sort of finally playing out, but we're slowly checking those off as well. So again, I think the S&P below the 200-day moving average, I would not be surprised if you see an acceleration below that level if you initially break it, because a lot of people, I think similar to what you're implying by your question, expecting a bounce here. And dip buyers are proven right every time on the way up until it doesn't work. And then all of a sudden, there could be a significant problem. Folks, thanks so much for joining me. Thanks for the thoughtful questions as always. I can't tell you how much I appreciate it. It makes the discussion a little more lively, a little more interactive, and I appreciate that very much. We're going to continue to monitor these markets day in, day out as we have rapid fire volatility and rapid fire news flow from Washington and around the world. So keep tuned here on my YouTube channel, on my social media outlets as we continue to navigate things. That's it for today. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night, folks.